Some buyers going to look at your business as purely a yield on invested capital, an ROI, an EBITDA multiple, of course. But what if there was a way to position your business such that it's in a more desirable bracket, a more we need to do this type of situation? How do you captivate and acquire? 3 approaches that we've seen work many, many times. That's what we want to dig into in this video. I'm Arthur Petropoulos, managing partner here at Hillview Partners. We're a middle market, lower middle market, M&A and capital markets firm. We help companies generating $1 million to $10 million a year in EBITDA, sell themselves, and find capital. So if the desire is to captivate and acquire, to get someone to really lock in and say, this is interesting, this is something that we want, which is 80% of what we're doing every day, selling businesses versus say the 20% of putting capital together for situations. What are 3 angles that will put you in a more desired bucket? First of these is what we call the missing puzzle piece. So as we've said in many, many of our videos, businesses get acquired for fundamentals, access, and capabilities. Fundamentals being the revenue, gross profit, operating expenses, EBITDA of a business as it stands, but the access being what end market does it serve, what customer base, what demographic, geographic, etc., and the capabilities being what does it do, what is its offering, why is it superior, what's unique, what is its edge, if you will. And it's the access and the capabilities that can make a business the missing puzzle piece. So if we are representing a company to the acquirer market and we say, here is your puzzle board, these are the things you do, these are the things you don't do. This is who you do it for, this is who you do not do it for. If we can paint the picture of the business we are representing as this fills the gaps of who you don't do it for, this fills the gaps of what you do not do but should want to do, that makes it captivating. That puts it into a situation where someone says, we need to do this, not just would it be nice to do. Secondly, is a buy versus build opportunity. Now, whether a company is looking to fill gaps in its access and capabilities, or whether it is just looking to traverse into unexplored waters, it is going to have a list of strategic objectives, growth objectives. Every business starts off the year going on the whiteboard saying this is the 5 ways we're going to grow this year. Now, if you can position a company to an acquirer in a way that you say, hey, you know those 5 things you were going to basically do ground up? You were going to take all the risk to try to just do it organically? Well, what if I could tell you, you could just buy the capabilities? So you could buy it instead of build it. You could buy the certainty of the outcome because this business has been doing these things for 20 years or some lengthy period of time, instead of having to take all of the risk. Now, risk and dollars are somewhat fungible. If someone feels like there's a low risk to accomplishing a big objective, they will pay a large dollar amount for the certainty of it. And that's what you're giving someone if you can position the company as this is one of the 5 things you wanted to do anyways. So instead of starting it ground up, instead of trying to just build it and they will come in the field of dreams and all of the wonderful, beautiful sentiment that comes along with that, if you could just buy something that's guaranteed to work, here's a path to do it. And that's going to be captivating. That's going to put the business in a bucket higher than the, hey, these things would be nice. And number 3 is loss aversion. And what we mean by this is the ability to avoid someone else getting something that you want. And so think from an acquirer's perspective. If they are in a competitive business of making widgets, of creating software, of providing a service, and they have competitors that largely do the same thing. Now say there's this magical, special type of service product offering that would be a real captivating component to their offering. If you think of competing businesses, about 90% of what they do is the same. It's really just these slight things on the edge that differentiate them. Fast food store might be the same thing, but if you could get that wonderful milkshake at In-N-Out Burger or Checkers or whatever, maybe that's why you go there. And so you could say the bulk of what the business does is similar, but it's this one extraneous element. And so if you can sell the business, if you can position a company as that one thing that might get them all the other fairly commoditized business, then really not only are they buying it because that would be wonderful for them, but they're also buying it because they do not want their competitor to buy it. This is a story from our own history. Is we've sold several companies where the closing element of it, where they said, is company ABC going to buy this if we don't? And if we say, and we're not going to lie, but if we say yes, that has oftentimes pushed the deal over the edge, because not only do they want it, but they so badly do not want someone else to have it, and they do not want someone else to have it and then exclude them from it, that will push the thing over the edge. So again, that idea of loss aversion can be a differentiator can be a captivating component. And so we have these three elements. We want to give you one bonus one. And this kind of captures a little bit of each of these categories, as we call it the Island A and Island B dilemma. Now, if a company is on Island A and it wants to be on Island B, and that can, again, be they have new capabilities, new geographical coverage, new demographic coverage, new service offerings, whatever it may be, if they perceive your company as the only means, the escape raft to get off Gilligan's Island and get to Atlantis, then they will want the thing. That will be captivating if that is the path. And again, sometimes it doesn't matter if it's a canoe or a rocket ship. If it gets from A to B, that's it. So the idea today is, if you're going to sell a business, are there going to be lots of people that just want to buy it based on your revenue, just want to buy it based on your EBITDA? Sure. But how do you really enhance and optimize the terms? How do you really captivate an acquirer? Fit the deal into one of these buckets. And let's recap them real quickly. 1, be the missing puzzle piece, whether via access or capabilities. 2, be the buy versus build opportunity for something they were already going to strategically pursue. And 3, be the thing that they don't want their competitor to have. And 4, as kind of a global arching theme or motif to this, is if you can be the thing that gets a company, or if your company, the acquisition of which, can get the acquiring company from Island A to Island B, that will be captivating. And so, best of luck as we all attempt to captivate whomever and whatever we're looking to pursue this week. Hope the week continues to go well for everyone. Keep pushing forward. God bless. We'll see you next time.